Well, greetings and salutations, Series 7 test takers. This is the Series 7 Guru coming to you from my studio here in fabulous Las Vegas with another explication request. The best free supplement to your paid study materials is my YouTube channel, but if you don't have a Kaplan Q Bank, I highly recommend it as a paid supplement. With my Guru 10 discount code at checkout, you can get the Q Bank for about $60. The other thing I'd recommend is the Quick Sheets. For that commercial, Kaplan allows me to give you a free look on Kaplan content. We help you with any question from any vendor. It's just easier if it's Kaplan because you can give me the QID and I can pull it up backstage. So this is QID 1370858. Man, whenever you've got a lot of stuff going on, the mantra is fire up the T. Fire up the T. If you're a student of the Guru, you know, the first thing we do when we get options is we fire up the T so we can track money in and out on a per share basis. I like to use dollars out, dollars in. Some people like to use debit credit. Some people like to use pluses or minuses. I don't use pluses or minuses, but I'll use them here to show you how that would work. The reason I don't like pluses and minuses is because they're easy to transpose. So we want to be disciplined as we go through the question, tracking the money in and out. If you're not struggling with contract specifications and you can track money, you're going to be in pretty good shape. So a customer bought 100 shares of Paradigm Publishing Corporation on October 17, 2020. The price was 83. So that's 83 out that we paid for the stock. Again, I recommend you do things on a per share basis. I'm not going to put $8,300 in here. I'm going to do a per share. Then when I'm all done, I can multiply once by 100 rather than multiplying all the way through, which I think gets kind of messy. It says on April 11th, 2021, the investor wrote a PPC call for 85 call for 3. So again, what I'm doing now is obligating myself to sell at 85. Stock I bought at 83. So hopefully you're not struggling that when you write a call, that's an obligation to sell the stock at 85. And you brought in 3 there. You did an opening sale. So that's our initial setup. So we get to our first thing here. We've got our setup, but now we're going to close it out, right? We're going to see what they say. So you should be thinking as a test taker, I'm going to have to do an initial setup, and then I have to do a closeout or offset, however you want to think about that. I always like, if you're struggling a little bit, maybe you want to put arrows just to remind you what the offset looks like, right? So I bought the stock, so I'm going to sell the stock. I sold the options. I'm going to buy the option, perhaps. We'll see what's going on, but that's what's typically going to happen. So at expiration, so that's important. This is November. So on the third Friday in November, the stock is selling at 90. Now, I don't like the question already because at expiration, I would get called away. But, this is Kaplan are kind of be jerky here and making you do it separately. But anyways, at expiration date, the stock is selling for 90 and I liquidate the stock. So that means I'm going to bring 90 in. So it looks like I made 7 points there or $700. I just want to check to make sure whether that's long-term or short-term. For that to be at long-term, I have to have been at risk in the stock for more than 12 months. And checking here, that is indeed true. Now, I don't have to worry about interrupting my holding period unless this was a put. I didn't offset the risk here. I created an obligation to sell. So maybe the test taker who requested this explication was confused about what happens if this was a put contract. It is not. It is not. It says the investor liquidates the stock at the market price, closes the option at intrinsic value. So I always like to put the market price above my strike price. So if this is an 85 call and the stock is 90, that's something you want to get comfortable with. I get lots of test takers who are always asking about time value, and I say it's not important. Time value erodes. At expiration, a contract is only worth its intrinsic value. It has intrinsic value, will be exercised, does not, it'll expire worthless. So, intrinsic value on the test is much more important because they use this phraseology on the test. You close out at intrinsic value. So the intrinsic value here of the 85 call is 5. And so it looks like I have a loss there. So it looks like I have a $700 long-term gain. And it looks like I have a 200 loss. Doesn't matter, by the way, if that loss is short-term or long-term because I'm going to net it. But let's see. I bought this call in November, April 11th, 2021. This is November 2021. So that's a short-term loss. So what I'm going to do now is I'm going to net that against my $700 long-term gain. So the end result is I have a 5-point long-term gain, 5 points. Again, we're doing per share. I'm going to times that by 100. And I get my gain, which is a $500 long-term gain. Let's put that in green because we're happy campers here at the end of the day. All right, so boom, let's just review. You might want to just guess being assigned to the universe, right? We're going to fire up the T. A customer purchased 100 shares at 83. That's dollars out. They wrote an 85 call for 3. That's dollars in. At expiration, the stock is 90. They sell the stock at 90. That's a 7-point gain. It's a long-term capital gain. They close out the 85 call at intrinsic value. Intrinsic value of an 85 call at 90 is 5 points. That's what we're doing our closing purchase for. And it looks like there we lost 200. So we have a $700 long-term gain, $200 short-term loss. We net that, and we have a $500 long-term gain. All right, so I hope you found that helpful. Remember, inch by inch, your Series 7 is a cinch, yard by yard, your Series 7 hard, and send me any explication requests you may have. Bye-bye.